The financial markets are ruthless. For every story of meteoric success, there are countless tales of traders who lost everything chasing a dream. Day trading, with its promise of instant profits and fast-paced excitement, has drawn millions to the screens, hoping to outsmart the market. But the stark reality is chilling. 95% of day traders fail. And the reason isn't always lack of knowledge or experience. It's the human mind itself. Day trading is a battlefield where fear and greed wage constant war. The markets don't care about ambition, discipline, or education. They react to human emotion. Traders walk into the market thinking they are rational, analytical, and ready for any scenario. Yet as the charts flicker and prices fluctuate, irrationality takes over. A green line becomes hope. A red candle becomes panic. The human brain, hardwired for survival, is not built for the rapid-fire decisions required in day trading. And this is where the first trap lies. The first major reason traders fail is emotional trading. Emotional trading is when decisions are driven not by analysis or strategy, but by feelings. Fear, excitement, impatience, and greed take the driver's seat. A trader may see a stock drop slightly and panic, selling at a loss rather than sticking to their plan. Or they may witness a sudden spike and chase the trend, buying at the peak in hopes of catching more profits. The result? Losses that compound faster than profits can ever grow. Markets do not reward emotion, they punish it relentlessly. Another psychological trap is overconfidence. Many new traders enter the market after a string of early wins. Perhaps a few lucky trades gave them a sense of mastery, and suddenly they feel invincible. Overconfidence leads traders to increase their position sizes, take unnecessary risks, and ignore stop-loss rules. The market, however, is indifferent. One wrong move can wipe out months of gains. History is filled with examples of traders who thought they were untouchable, only to be humbled by a sudden market shift. Closely linked to overconfidence is impatience. Day trading requires constant monitoring and waiting for the right setup, but the human mind craves action. Waiting for confirmation, observing trends, and exercising patience can feel boring, even counterintuitive. Traders often enter positions too early, ignore proper analysis, or overtrade to force profits. Overtrading drains capital and amplifies mistakes. The impatient trader is almost always a losing trader. Beyond emotion, there is a fundamental lack of proper risk management. Many traders underestimate how important it is to protect their capital. They risk too much on a single trade, fail to set stop losses, or allow small losses to grow unchecked. Day trading is not about winning every trade. It's about managing risk and surviving to trade another day. Yet, in the rush to make quick money, many traders gamble instead of trading. The consequence is inevitable. Losses accumulate until accounts are wiped out. Another hidden reason for failure is misunderstanding market structure. Markets are not random, but they are complex systems influenced by countless factors: news, sentiment, macroeconomics, and institutional activity. Many new traders rely on intuition, hunches, or popular tips from forums. They ignore the patterns, indicators, and signals that professional traders respect. Without understanding the broader structure of the market, every trade is essentially a coin toss. Education alone does not guarantee success. Books, courses, and webinars teach theory, but theory without application is useless. Many traders can recite technical indicators, candle patterns, or chart setups. Yet, under real-time pressure, they fail to implement the rules consistently. Knowledge becomes irrelevant if it cannot survive the stress of live trading. This is why simulation and practice under real conditions are crucial, but often neglected. Another overlooked factor is failure to adapt. Markets evolve. Strategies that worked yesterday may fail tomorrow. Many traders cling stubbornly to a single method, refusing to adjust to changing volatility, trends, or liquidity. Adaptability is a skill that separates the survivors from the failures. In day trading, rigidity is a silent killer. Traders who cannot learn from mistakes or adjust to new market conditions inevitably fall into the 95%. Technology, often seen as a solution, can also be a curse. Trading platforms, real-time news feeds, and automated alerts create information overload. Traders are bombarded with signals, opinions, and charts. leading to analysis paralysis. Decision-making becomes clouded, and even the most prepared trader can make catastrophic errors. Modern day trading demands not just skill but discipline to filter the noise and act with clarity. The environment around the trader plays a role as well. Trading in isolation, without mentorship or a support system, increases the likelihood of failure. Traders who cannot discuss ideas, validate strategies, or gain feedback often reinforce bad habits. Social pressure, online hype, and misinformation amplify mistakes. Day trading is not just a skill, it is a mindset. The absence of guidance or accountability accelerates failure. One cannot ignore the financial pressures that weigh heavily on day traders. The allure of quick profits often masks the reality of financial stress. Traders using essential savings, borrowing money, or hoping to replace income immediately are operating under extreme pressure. Stress clouds judgment, encourages reckless decisions, and shortens patience. The combination of emotional strain and financial dependency is a perfect storm for failure. It's not all doom and gloom. Understanding why traders fail is the first step toward avoiding the traps. Successful day traders approach the market with a blend of discipline, preparation, and emotional control. They respect risk, limit exposure, and follow tested strategies. They understand that losing trades are inevitable, but managing losses is what preserves long-term success. Survival is more important than winning every battle. Successful traders also cultivate a mindset of continuous learning. Markets change, and so must traders. Analyzing past trades, studying new patterns, and adapting strategies is part of the routine. The trader who refuses to evolve becomes obsolete. The key difference between the 5% who succeed and the 95% who fail is not luck. It's the relentless commitment to discipline, learning, and emotional mastery. In the end, day trading exposes a simple truth. The market doesn't care about hope, wishful thinking, or desire. It rewards preparation, discipline, and mental resilience. The statistics are sobering, but they are not final. Traders who understand their psychology, respect risk, and prepare meticulously have the chance to beat the odds. For the majority, failure comes not from the market itself, but from ignoring the human element, the most important factor of all. The story of why 95% of traders fail in day trading is a cautionary tale of the mind under pressure. It is a story of ambition, emotion, and the ruthless logic of the markets. For every trader who dreams of fortune, there is a lesson hidden in failure. Patience, discipline, preparation, and humility are the true currency of success. Day trading is not a game of chance. It is a test of character, resilience, and the ability to master oneself. The lure of day trading is irresistible. The promise of quick profits, the thrill of the market, and the dream of financial independence. Millions are drawn to screens each day, believing that with the right strategy, they can beat the market. Yet the statistics are unforgiving. 95% of day traders fail. The reasons go far beyond emotion and psychology. Failure often stems from poor strategy, flawed risk management, and an underestimation of the market's complexity. At the heart of day trading lies a simple truth: a winning strategy is not enough without discipline and risk control. Many novice traders spend weeks or months perfecting a chart pattern, memorizing indicators, or copying a foolproof system from online sources. Yet, when the market moves in real time, these strategies crumble. The problem is not the strategy itself, but the way it is applied or misapplied under pressure. One common error is overcomplicating trading strategies. Beginners often layer multiple indicators, moving averages, oscillators, and Fibonacci levels in the hope of predicting price movements with precision. The result is not clarity but confusion. Signals conflict, charts become noisy, and the trader is paralyzed by indecision. In reality, simplicity is often more effective. Professional day traders rely on a few reliable signals, testing them rigorously and avoiding unnecessary clutter. Complexity may feel sophisticated, but in trading, it often leads to catastrophic mistakes. Another critical reason traders fail is ignoring risk-to-reward ratios. Successful traders understand that no strategy is perfect. Losing trades are inevitable. What separates winners from losers is the ability to manage losses relative to potential gains. Many traders focus solely on potential profits, entering trades with little thought to downside risk. They may risk 5% of their capital for a potential 2% gain. Even if the trade works out, the risk is misaligned. Repeating this pattern leads to account depletion faster than profits can accumulate. Stop losses, a cornerstone of risk management, are frequently misunderstood or ignored. Traders often set stop losses too tight, only to be stopped out by normal market fluctuations, or too wide, exposing themselves to devastating losses. Proper stop placement requires understanding volatility, support and resistance, and market context. Failing to set effective VE stops is not just a technical error. It is a fundamental flaw that turns small mistakes into large, account-threatening losses. Position sizing is another area where traders stumble. Many beginners go big on a single trade, hoping to capture a life-changing profit. The truth is that no trade is guaranteed. Day trading is a numbers game where survival matters more than winning a single trade. Successful traders risk only a small fraction of their capital per trade, often 1 to 2%, ensuring that even a series of losses does not wipe out their accounts. Ignoring this principle is one of the fastest paths to failure. Overtrading is a consequence of poor strategy discipline. Traders, eager to make money, enter too many trades, chasing every fluctuation. Each additional trade increases exposure to risk and reduces the quality of decision-making. High frequency does not equal high profitability. In fact, overtrading amplifies mistakes, drains capital, and erodes confidence. The market does not reward activity, it rewards precision. Many traders fail because they misunderstand market structure and liquidity. A strategy may seem profitable in a calm, simulated environment, but live markets are unpredictable. Price gaps, low-volume trades, and sudden reversals can devastate unprepared traders. Understanding where liquidity is concentrated, how institutional players move, and how market microstructure affects execution is essential. Traders who ignore these elements are essentially gambling, not trading. Another hidden trap is failure to adapt strategies to changing market conditions. Markets are dynamic. A trend that worked last month may fail today due to shifts in volatility, sect, or rotation, or macroeconomic news. Rigid traders cling to outdated methods, refusing to test or refine their approach. The ability to adapt, backtest, and optimize strategies is what separates successful traders from the 95% who fail. Technology, while a tool for efficiency, can also exacerbate failure when relied upon blindly. Automated systems, algorithmic alerts, and trading bots give the illusion of precision. Yet they are only as effective as the rules programmed into them. Without proper monitoring, a bot can execute losing trades repeatedly, magnifying errors at speeds humans cannot react to. Traders who do not understand the logic behind their systems surrender control to a machine, and often to the market's mercy. Another reason traders fail is ignoring transaction costs and slippage. Day trading requires frequent buying and selling. Commissions, spreads, and slippage may seem small per trade, but they accumulate rapidly. A strategy that appears profitable on paper may be unprofitable once costs are included. Many traders fail to account for these realities, only realizing too late that their winning system was flawed when execution realities are factored in. Journaling and performance review are frequently overlooked aspects of strategy success. Successful day traders meticulously record every trade, entry, exit, rationale, and outcome. They review mistakes objectively, identify patterns of failure, and refine strategies. The 95% who fail often refuse to face the truth in their trades, blaming luck or market manipulation instead of analyzing their own errors. Without honest assessment, improvement is impossible. Psychology intertwines with strategy. Traders who cannot control their fear or greed often sabotage their own systems. A well-designed strategy can fail if emotional impulses override its rules. This is why discipline is as important as the strategy itself. Rules are only valuable if followed consistently. Inconsistent application of even the best strategy leads to failure. Capital allocation is another often overlooked factor. Many traders enter the market with insufficient funds to withstand normal market swings. A small account can be wiped out by a few losing trades, no matter how technically sound the strategy is. Risk per trade must be proportionate to total capital. Traders who ignore this principle expose themselves to catastrophic failure. Finally, many traders fail because they chase strategies rather than mastering them. The internet is full of holy grail systems, from scalping methods to Fibonacci hacks. Traders jump from one strategy to another, never giving themselves time to master a single method. Mastery requires repetition, experience, and adaptation. The constant chase for new secrets ensures superficial knowledge and repeated losses. The store. Why of day trading failure is not just about losing money. It's about ignoring fundamental principles of strategy, risk management, and discipline. The 95% who fail are not always unlucky. They are unprepared, overconfident, undisciplined, or misinformed. They treat the market like a game of chance rather than a complex system requiring skill, patience, and preparation. In contrast, the 5% who succeed approach day trading differently. They design simple, tested strategies, manage risk meticulously, control position sizes, and protect capital above all else. They trade with a plan, review every mistake, and adapt to changing conditions. They accept that losses are part of the game and focus on surviving to trade another day. In the ruthless arena of day trading, survival is the first victory. Day trading is a demanding profession. The fast pace, high stakes, and technical complexity create a perfect storm for failure. But it is not impossible to succeed. By respecting risk, mastering strategy, and maintaining discipline, a trader can overcome the odds. The difference between the 95% who fail and the 5% who succeed is not luck. It is preparation, patience, and persistence. Ultimately, day trading exposes the harsh reality. The market is not there to make anyone rich overnight. It is a mirror reflecting a trader's skill, discipline, and understanding of risk. Ignoring strategy, mismanaging risk, and chasing shortcuts ensures failure. Those who embrace these principles, however, can survive, grow, and thrive in a world where 95% falter. Day trading is not a hobby. It is a profession, and only those who respect its rules can hope to endure. Stock market moves fast, sometimes too fast for the human mind to keep pace. For day traders, the promise of instant profit is intertwined with the risk of instant loss. Across the globe, millions log in each morning, hoping to turn strategy into cash. Yet, the brutal reality remains, 95% of day traders fail. While psychology and strategy are critical, another layer often goes unnoticed: the environment itself. The market's volatility, unpredictability, and external forces that can crush even the most disciplined trader. Markets are complex systems. Prices reflect a constant negotiation between buyers and sellers, institutions and retail traders, algorithms and human emotion. Day traders often believe that with the right knowledge they can outsmart the market, but the market has its own rules. It doesn't follow intuition, wishful thinking, or hope. External forces, from economic announcements to geopolitical events, can send prices skyrocketing or plummeting within minutes. Traders unprepared for such shocks are caught off guard, often with devastating results. Volatility is a double-edged sword. On one hand, it creates opportunity. Rapid price movements can turn a small position into a significant profit. On the other hand, it magnifies risk. Day traders who fail to understand volatility often miscalculate position sizes or set stops too tight. In high volatility moments, even a carefully planned trade can be wiped out. The market does not negotiate with emotion. It reacts to events, liquidity, and sentiment. Those who ignore the true nature of volatility are doomed to join the 95% who fail. News and macroeconomic events play a profound role. Earnings reports, interest rate decisions, political crises, or sudden regulatory changes can move markets unpredictably. A stock that seemed stable in the morning can swing violently by noon. Retail traders, especially beginners, are often blindsided by news they didn't anticipate. Reacting to headlines without preparation is a common cause of catastrophic losses. Traders must not only analyze charts, they must interpret the world around them and understand how information shapes price action, Liquidity is another external factor that separates winners from losers. Markets are not uniform. Some stocks, ETFs, or commodities have deep liquidity, others are thinly traded. Entering or exiting positions in illiquid markets can be treacherous. Large orders can move prices, causing slippage that erodes profits or turns winning trades into losing ones. Many traders fail because they underestimate the impact of liquidity on execution. The market itself, not the trader's strategy, dictates outcomes in such cases. Institutional influence cannot be ignored. The majority of day trading volume is driven by large institutions, hedge funds, mutual funds, and proprietary trading desks. These players have resources, technology, and capital far beyond retail traders. They move markets with speed and precision. Retail traders attempting to compete on equal footing are often outmatched. Understanding institutional patterns, market depth, and order flow is crucial, yet overlooked by most. Ignorance of these forces is a key reason why 95% fail. Algorithmic trading has transformed the landscape further. High-frequency trading algorithms operate in milliseconds, exploiting inefficiencies and reacting to market signals faster than any human can. Day traders using manual systems are at a disadvantage, facing sudden liquidity gaps, unexpected reversals, or flash crashes. The market, in effect, has become a high-tech arena where human reaction times are rarely sufficient. Traders who do not account for algorithmic influence find their strategies disrupted, often repeatedly. External environmental factors extend beyond the charts. Internet outages, software glitches, power failures, or brokerage issues can destroy opportunities in an instant. Many traders fail to consider operational risk, the risk of losing access or functionality at critical moments. A perfectly timed trade can be ruined by technology failure. Success in day trading requires not just strategy, but preparation for real-world contingencies. Psychology interacts with external forces in dangerous ways. Rapid price swings, unexpected news, and sudden reversals test even the calmest trader. Fear and panic magnify losses. Greed tempts traders to chase opportunities they do not fully understand. Traders who cannot remain detached from the external chaos often override their own rules. The environment becomes a test not only of skill but of mental resilience, and most fail under the pressure. Market cycles and broader economic trends also play a role. Bullish markets may mask weaknesses in strategy, encouraging overconfidence. Bear markets expose risk, and strategies that worked in calm conditions may fail spectacularly. Traders who do not understand the macro context of their trades are sailing blind. Ignoring these cycles is a subtle yet powerful reason for failure. External competition is another underestimated factor. Retail traders are not alone. Every move is countered by thousands of other participants, including professionals with decades of experience. A market that seems predictable is in fact a constantly shifting battlefield. Traders who do not respect the competitive environment often overestimate their edge, risking too much or entering trades without proper context. Even successful traders face environmental challenges daily. Sudden economic data releases, unexpected political announcements, or natural disasters can create events that no strategy can perfectly anticipate. Risk management is designed to mitigate these shocks, but traders without strict discipline are vulnerable. In day trading, survival depends not only on skill but on anticipating, preparing for, and reacting appropriately to the external forces that can strike without warning. Education helps, but knowledge alone cannot shield a trader from environmental factors. Many fail because they underestimate the market's unpredictability. Preparation involves more than strategy. It requires awareness of macroeconomic trends, global events, institutional activity, and technology limitations. The trader who fails to account for these forces is gambling with their capital, and the odds are overwhelmingly against them. Risk management intersects with the environment. Traders who plan for volatility, set appropriate stops, and control position sizes can survive shocks that would destroy others. Survival, not profit, is the first priority in a world where the unexpected is constant. The 5% who succeed recognize that markets are not static. They are dynamic, chaotic, and influenced by countless external factors beyond their control. Resilience is therefore essential. Traders must accept that losses will occur, that external shocks will disrupt strategies, and that unpredictability is inherent in the system. The ability to recover, learn, and continue is what differentiates the survivors from the majority who fail. Day trading is not merely technical. It is a discipline shaped by environment, psychology, and preparation. Ultimately, the 95% of traders who fail do so not because they are incapable, but because they underestimate the power of the market itself. External forces, volatility, news, liquidity, institutional influence, and operational risks interact with human psychology and imperfect strategy to create a perfect storm. Ignoring these forces, or assuming they can be fully controlled, is a fatal mistake. Success in day trading requires a holistic approach. Traders must combine strategy, risk management, psychological control, and environmental awareness. They must prepare for the unexpected, respect the limits of their knowledge, and understand that the market is bigger than any individual. Only those who integrate all these elements can hope to survive, adapt, and thrive in the fast-paced world of day trading. Day trading exposes one undeniable truth. The environment is as unforgiving as the trader's own mind. External factors will test, challenge, and sometimes crush even the most prepared individuals. The difference between the 5% who succeed and the 95% who fail lies not just in talent, education, or luck. It lies in the ability to respect and adapt to the world outside oneself. To succeed, a trader must master not only the strategy, but also the environment in which the strategy operates. Day trading is not a mere gamble. It is a high-stakes arena, shaped by human emotion, technical skill, and the relentless force of the market itself. Those who fail are not unlucky. They are unprepared for the reality of the system they chose to engage. Understanding this reality, preparing for it, and respecting it is the key to joining the small, victorious minority. The environment will always challenge the trader, but mastery over oneself and respect for the market can turn survival into success.